I have shared the in this case PDF form, right, in the Google Classroom. So we go into equity first, and then when we do the tutorial, I will go back a bit on the liabilities. Is that okay? Can you see my equity PDF form now?
Yes.
Yes, madam.
Yes, madam.
So it's only 23 slides. So let's do this equity and finish it so that we can do the tutorial. Okay. All right. So equity, right? So if you look at your financial statement, right, statement of your financial position, you have your asset, liabilities, and owner's equity. So we are looking at that part where we have the owner's equity. Yeah, so we call it as a equity. So for equity, there are two types of equity. One is the capital, what we call what is actually the share capital, and the other one is the reserve. And this reserve is further break into retained earnings, capital reserve, and revenue reserve. Right? So these are the equity of companies and its component. So capital, so we have share capital, and normally you see retained earnings, right? Because why under the retained earnings, you can later you see that what is a capital reserve, and we also have the revenue reserve. So the definition is that asset equals to equity and plus liabilities, right? Or putting the other way around, equity equals to asset minus liabilities. So if you look at the equation here, it says that you will have equity when your asset is more than your liabilities. Or in other words, we are saying that your equity is what is left of your asset after you deduct your liabilities. Right? Is the residual interest or the leftover in an entity's asset after deducting liabilities. So it means that from here you see that if you have equity, if you have asset more than your liability, so that will be your equity. Equity is the capital that shareholders contribute to have a share ownership in the entity in the form of shares. So that is the capital. The next one is that component of equity. So the first one is capital, where it's actually the funds contributed by the shareholders to have a share in the entity. Is in the form of shares, and the shareholders are the owners of the entity. So this one is very straightforward, right? So when you have your share capital, you know that these are the money invested by the shareholders, and the shareholders are the owners of the entity. And you also have the reserve, right, where amount put aside for future contingencies and or for investment for future growth. So sometimes a company, when they have profit, so some of the profit will be kept in the form of reserve. Yeah, so you do not distribute all your profit to the shareholders. So the types of reserve here, we have the revenue reserve, right? So this reserve is created from revenue profit that an entity earns from the daily business operation. All right, so remember that from your profit and loss account, you have your revenue minus expenses is your profit. All right, so the profit will go into your account, what we call a retained earnings account. All right, so from the retained earnings account, you see that you can actually pay out dividend out of the reserve. All right, in this case, we're talking about the retained earnings. So if you pay out part of the profits, all right, in the form of dividends, all right, so that will be taken out from the retained earnings. All right, but if it's not, then it will be retained as a reserve. That's why it's called retained earnings. Yeah. For example, is that you have the retained earnings and the general reserve. All right, capital. The other one is the capital reserve. It's created to meet a specific purpose, such as to maintain entities' capital structure or to redeem long-term debt, such as debentures. All right, so this capital reserve is a special reserve. For example, we have the share premium, we have capital redemption reserve, sinking fund reserve. So this one is created along the way. Yeah. So we'll see that later, how are we going to have this reserve. Here you say that two types, but actually here we have three types of shares. We have the ordinary shares. So this one under share capital. Ordinary shares, you have the preference shares, and you have the deferred shares, right? So why you have the different types of shares? Because it differs in the form of voting rights, all right? And the priority to receive dividends. The return, which is the return on invested capital in the event of liquidation or winding up of the company. So that's why we have different types of shares, all right? But these different type of shares have the different criteria, yeah? Right, so let's look at the ordinary shares. It gives rights to ownership, all right? So these are the effective owners of the company that carry voting rights. So in the AGM, they can vote for the whatever is discussed during the meeting, right? And the ordinary shares bear the greatest risk but stand to receive the highest return, right? You of course the risk is always there, all right? Dividend received are not fixed depending on how the company decide. Dividends entitlement rank last, and distribution of asset upon liquidation rank last. So it means that if the company goes into liquidation, what do you mean by liquidation? Means that the company close shop, right? Or the company decided to wind up, right? So whatever profit that they have, the company will be distributed to the shareholders, right? So in the case of ordinary shares, they are the last who are going to be who will receive the dividend. If there is no more to be distributed, then the ordinary shares will not get any dividend or distribution of asset when the company liquidate, right? And then the second type of shares is what we call preference shares. The name is preference, so it means that they are the preferred shares, yeah. But the preference shares, the dividend is fixed, all right. So you can see that it say that 8% preference shares, all right, or 6% preference share. It means that the dividend for that shares is 8%, 6%. So if the company is doing okay, all right, they still got 8. If the company not doing okay, they still get 8%, yeah. So it's fixed whether this disregard of the performance of the company. All right, it carry preferential rights, means that's why it's a preference shares, right? Dividend payment rank before payment to ordinary shareholders. So whenever the company wants to make payment of dividend, all right, they will receive first the preference shares. All right, they also receive priority in distribution of assets upon liquidation. However, the preference shares do not carry voting rights, so that they cannot vote in the annual meeting, right? In the annual general meeting. They cannot choose their board of directors, for example. And then under another preference shares, we call it as a preference shares, we have the redeemable preference shares, right? So it means that the preference shares is redeemable in the future at a predetermined date. So it means that if the normal preference shares, you don't have time. Anytime you want to redeem, all right, you just sell your shares if it's an open shares, right? Public shares, for example. But if it's a redeemable preference shares, it's stated in the issuance of the shares that this has to be redeemed on a certain date, right? So when the time comes, you redeem the shares, it's a compulsory repayment by the company, right? It's similar to a loan, as the entity is obliged to repay regardless of its financial standing. So whenever there's a redeemable preference shares, when the shareholders redeem their shares, right, a company has to make payment. All right, under Malaysian Financial Reporting Standards 132, all right, this redeemable preference shares is a financial liability or debt, and it's not an equity. All right, therefore, the dividend on the redeemable preference shares is to be expensed off to in the profit and loss account rather than appropriated. All right, so you'll see that will be an expense in a similar manner as interest on loan, because it's actually it is a loan, right? But it's named as a redeemable preference share, but they also receive I'm not sure whether they have a dividend or not. Yeah, they have dividend, but dividend is paid out of their not from the retained earning, but as expense of. All right, deferred shares is the third type of shares, all right, known as a founder shares, given as a token to founders to appreciate their efforts in founding or forming the company. They are the last priority to receive dividend and capital repayment on liquidation, right? Means that the rank is that the first one would be the preference shares, the second one is the ordinary shares, the third one would be the deferred shares. Okay, let's look at the difference between equity and debt, right? So equity is in the form of shares, Debt instrument is in the form of debentures. So debentures, you covered that when you do your liabilities last week. Yeah. So equity here, we have the fluctuation return on investment. All right. So especially if it is an ordinary shares, the dividend or the return on investment is not fixed, except for the preference shares. Yeah. The holders of the shares are the owners, but here the holder of the debt instrument or the debentures are the creditors. Holders have voting right. The debentures, they don't have any voting rights. Lower priority in assets distribution. So it means that if there is a liquidation, asset distribution, the shareholders or the owners will have lower priority, but the debentures or they call it what, debt holder, right? In this case, they will given higher priority, right? Dividend equals to appropriation of profits, yeah. But interest is the expense. So you see that in the profit and loss account, but dividend you see in other comprehensive income account. Right, issuance of shares. Right, so what we have here is the initial public offering. Here, when say initial public offering, we are referring to stock which is, or shares which is offered in the stock exchange. Yeah, we are not referring to a company in the Sendian Berhad. Right, Sendian Berhad, they only can issue shares up to 500. How many what's the numbers for the shareholders in a Sendian Berhad? Anyone? It's a limited, yeah, Sendian Berhad. So I think that there's a limit, I think up to 50 members only. Yeah, but if you put it in the public, it's a public company, then you can open the shares to the public. But initial public offering means that you all these are actually market in the Bursa Malaysia. The first sale or offer of shares made to public investors, so that's what we call initial public offerings. All right, the main purpose is to raise capital, and the companies listed on the stock exchange, which is the Bursa Malaysia, can issue shares to public, provided in compliance with the Security Commission requirement. As of August 2009, two markets in Malaysia. We have the main market and the ACE market, right? Assess certainty and efficiency. All right. So these are some of the basic terminology when you are dealing with shares. We have the authorized share capital. Yeah, authorized shares is the maximum shares an entity is allowed to issue or to offer to the public, right? But the issued capital is the shares that have been issued to the subscribed by the shareholders. So it means that if you have authorized share capital of 1 million, the issued share capital, the maximum issued share capital is 1 million also. But you can also issue only 500,000, right? And then we have another 500,000 which is unissued. The issue price is the amount per share an entity will receive from issuing shares. Yeah, so that is because when you issue shares, there is a price for the shares. So transaction costs incurred and borne by the issuer include registration, legal, printing costs, stamp duties, etc. So to be offset against the proceed received from the issue of shares. So whenever you have a transaction cost, all right, you have to take it out from the receipt of shares. So for example, you total receipt from issuance of shares is 100,000 and issuance cost is 10,000. So the net proceed from the shares is 90,000. So when you want to record in the journal entries, you're going to record the 90,000. So later we look into the journal entries. So these are the accounting entries for issuance of shares. All right, when you issue shares, all right, means that you receive cash. All right, you receive money, so you debit your cash or debit your bank and credit your share capital. Right, ordinary share capital, OSC. Right, credit, because why? It's an honest equity. And similarly, if you issue preference shares, you debit your bank and credit your preference as share capital or PSC. Right? You can just write OSC or PSC. Capital account is always a credit balance because it's part of the owner's equity. So changes in capital structure, movement in share capital can be due to bonus scrip, a bonus issue or scrip issue, or the right issue. Right, so means that now, for example, we do have investment in the form of share capital or preference share capital. All right, ordinary share capital and preference share capital. All right, so but there also be a movement in the share capital because of the bonus issue or for the right issue. So what is a bonus issue? Shares issued, sorry. All right, shares issued to existing shareholders free of charge. All right, means that the company issues shares to the shareholders, but the shareholder don't have to pay anything for the shares. All right, and normally this is given in a proportion to the shareholdings. All right, so for example here, the bonus one given is basis of 2 for 5. So means that for every 5 shares that you have, you get you get 2 bonus shares. Right, you will get 2 bonus issue. Shareholder will be given 2 shares free of charge for every 5 shares held. There is no cash impact, inflow or outflow of fund, but only dilution of net asset value. So what does it mean by that? Example here, we have issued ordinary shares is 200,000 of 100,000 unit at 2 ringgit each. Right? At 2 ringgit each means that you have how many number of shares? You have 100,000 issued shares. Yeah. So each one is 2 ringgit. So that's how you get 200,000. So the bonus shares, if we say that just now, example is that basis of 2 for 5. So means that what you do is that for every 5 units, you are going to give 2 bonus shares. So what you do is that 100,000, for every 100,000, for you divide by 5, you times by 2. Because why? For every 5, so 100,000, right? For how many 5 that you have, you divide by 5 times by, because for every that you're going to give 2 new shares. Yeah. So 100,000 divided by 5 times by 2, you get 40,000 units of bonus shares. Yeah. So in terms of the bonus shares, it means that beginning of the year, you have 100,000, but now you have additional shares of 40,000. So total at the end of the day, you have 140,000 number of shares. All right. Initially, you have 100,000 shares and each shares is 2 ringgit. Yeah. But now you have 140,000 shares. But there's no money in, there's no in also but the value of the shares now have to be revised because this 140,000 is, all right, you have 200,000, initially 200,000, but this 200,000 is for 140,000 shares. So now initially it was 2 ringgit each, now it becomes 143. So as you can see that's why it says that the dilution in the dilution of the net asset value. So it means that the value of the shares initially was 2 ringgit each, but now it's only 143. The good thing is that to the shareholders, they have more number of units. All right, because for every 5 units they have, they get additional 2 units. Yeah. So if you have 10,000 divided by 5 times by 2. So that will be the unit that you will get as a bonus. All right, it's recommended when has large accumulated profit but does not wish or unable to distribute them as cash dividends. So sometimes company they want to normally they give shareholders in the form of dividends. All right, dividends is a cash dividends, but because company may not able to distribute cash dividends, so what they give is that they give the shareholders in the form of shares. So these shares is in replacement for the cash dividends. Maybe for the year the company cannot pay cash dividends, so that's why that year the company give bonus shares. All reserve can be utilized for bonus issue. For example, you can have share premium, retained profit, general reserve. The accounting entries when you have bonus shares is that you're going to debit your bonus shares and credit your ordinary shares. Remember that the ordinary shares is your owner's equity. So increase in ordinary shares of 40,000, right? Debit your bonus shares. And at the same time, all right, in order to set off these bonus shares, you're going to credit the bonus shares and put that everything into a reserve. So that's why you debit your reserve account. Yeah, so your bonus share will be cut off here, debit and credit. So you only have the debit reserve and credit ordinary shares. But you have to put these two general entries first, yeah. Okay, the next one is what we call right issue. Yeah, the main purpose of the right issue is to raise additional capital. Is this an invitation to existing shareholders to purchase additional shares in proportion to their shares held? Yeah, so it's made at a price that is lower than the market price. So the right issue is also normally given to staff of the company. It means that in order to raise capital, they invite staff of the company, especially those who have been working for some time, right, to purchase shares of the company at a lower price. All right, means that the share price is lower than the market price. So that is an invitation, all right, to get more people to invest. And in this case, we are actually giving, we call it as a loyalty shares, yeah. All right, the shareholder may decide, so if the shareholder is given an opportunity to purchase the shares, you can accept the offer to take up the shares, or you can sell the rights to a third party. So for example, if I were given a right issue, all right, to buy 10,000 shares at 6 ringgit, for example, where the market price is 8 ringgit. So if I do not want to buy the shares, then I can sell my rights to a third party. And then you can also renounce the rights in favor of the company, whereby the company may offer the shares in the open market. Yeah. So whenever there's if for example, in the case of where the company is right issue, all right, they are going to receive cash, so debit your cash and credit the ordinary share capital. Okay, return on equity, right? So this is what we say that a return on your investment, right? A measure of profitability in relation to equity expressed in a percentage. All right, how much profit you make out of the equity. The formula is that ROE equals to your net income over average ordinary equity. So we use ordinary shares only, right? So when you want to take average, you look at the opening balance and the closing balance divide by 2. That's how you get average. Yeah, so your net income, look at your profit and loss account, the net income, and then you divide by the share capital, opening balance plus the closing balance divide by 2, that will be your average ordinary equity. Whether ROE is good or bad will depend on what is normal for the industry or company's peers. Right, so I think that for this topic, you should know is that what would be the journal entries when the company issues shares, all right, and then when there is a share, what do you call that, bonus shares, all right, and then when there's a right shares, yeah, the right issue, bonus issue, and the right issue. Accounting entries when there's an issuance of shares, okay. And of course, other than that, this one most likely you'll be tested on the theoretical. Yeah, they can have many question theory that can be right generated from this understanding. So far, so good. All right. Let's look at your. So that covers your equity, and that is in about 30 minutes. Okay. So now I would like to go back a bit on the liabilities. Right, I think that number 16. So liabilities is normal lah. When you have your accounts, you have the trade liability, trade creditors, right? But when you have the question on these liabilities, normally it will be on the bond or debentures, right? That is the most common financial liability, which is the bond or debentures. It's a long-term debt issued to public. Subscribers of the bond or debenture can involve multiple lenders known as a bond holders or debenture holders. So normally the bond is issued in a block of 100 or 1,000 face or par value. Bond debentures holder demand for interest to be paid to them in return for money loaned to the entity. all right, return earned on the investment made in the entity's bond or debentures. Right, the actual interest rate, all right, attached to the specific bond paid to the bondholder is known as a nominal interest rate. The effective interest rate is adjusted for compounding effects, right, used as a basis for amortization. Upon issuance of the bond, each holder will get a certificate containing all relevant details such as face value of the bond, name of the issuer, maturity period, repayment amount, or nominal interest. So now, just to put it together, all right, so when the company needs money, all right, if they need to raise cash for the company operation, so they have two choices. One is that whether they are going to issue shares, whether the shares is ordinary shares or preference shares, or number two, they are going to issue bonds. All right, so when they issue bonds, all right, they are actually invited creditors. So these are the creditors, but the shares here is the owners. So that's the difference. It may be issued at less than face value. For example, here bond face value 100, issued at discount of 1%. So if you discount 1%, what you get is only 99%. So what you have to do is that the 10,000 units of bond, 100 ringgit per bond times by 99%. Yeah, why 99%? Because it was issued at discount. So if it's issued at a premium, right, then you will get, you have to times by 100 plus something. Yeah. The repayment or redemption of the bond at maturity often will be either at face value or premium. So it means that when you issue discount, right, when you issue the bond, what you get is only 990,000. But upon maturity, you have to pay at least the FAR value, at least. So FAR value is 1 million here, is it? Yeah, 1 million. Yeah, 1 million or more. So if it's issued at more, that means that it will be issued at, will be redeemed at premium. Right, let's look at an example here. You issue 20,000 2% debentures at face value 100 per debenture. Company issue cost of 100,000. Redeemable at a premium of 5% after 4 years. Effective tax rate is 4.58%. Disclose the relevant information in the SOFP. And for each of the 4 years of the debenture, show the notes to the account for finance costs for each of the respective 4 years. So what you have to do is that here you have to recognize what is the bonds, the future value of the bonds would be. Future value means that you're going to pay the bonds later, right? 20,000 units times by 20 20,000 units times by 100 per debenture, right? So 100 ringgit times 200 units or 20,000 units. 20,000 units, right? 20,000 units times by 100, you have 2 million. This is what we call the par value, right? The cost of the issuance is 100,000, so you minus 100,000, so the net proceed is 1.9 million. So your journal entries will debit your bank 1.9 million and credit your 2% debentures, including your financial liability. So that is 1.9 million credit. Why credit? Because it is a liability, right? So this is to identify net cash received from issuance of debentures. Number two is that identify total finance costs. So cash paid over the life of the debentures. So look at the debentures here. It says that 2% debentures. 2% debentures per annum, so that 2 million is the value of the bond times by 2%. So it's 40,000 per annum times by 4 years. So you have 160,000 total cost of the finance. All right, that 160,000 is the 4 years, because why? The maturity is 4 years. The redemption value at 5% premium would be 2 million times by 1.05. Why is it 1.05? Because it's at premium. If at discount, then it will be 0 point something. Yeah, 1 is always the par value. So anything above 1 is at premium. Anything that is below 1 is a discount. So when you are going to redeem later, you have to pay out 2.1 million. All right, and total paid means that your total interest here plus your redemption value, that will be 2.260. So the difference, which is 2.26, all right, minus how much you receive, 1.9 million, is 360,000. All right, to be spread over 4 years period using interest rate of 4.58. So this one you don't have to worry so much at this level, yeah. So the journal entries that you're going to record the difference here, yeah, 360 that will be amortized over 4 years period. So you're going to debit your debt finance cost 360 credit 1,000 and credit your financial liability 360,000. Right? So that amount will be, so I think that you don't have to worry about this table, right? And the disclosure is that 2047, oh, you have to look at this. Oh, jadi complicated pula. Hold on, ya. Let me see. Journal entries. Okay, you snap on this. This is very important. When you issue debentures, all right, in this case 2.1 million, how do you get the 2.1 million? Credit 2.1 million. Oh, this issuance of debentures, is it right? Is it issuance of debentures? 2.1 is the redemption, right? This one is not issuance. This one is the, correct me if I'm wrong. What is this? This one is redemption, right?
Yes, madam.
Redemption of debentures, debit 2% debenture means that you set credit. Credit your bank because you have to pay 2.1 million. All right, finance cost for the year, how do you get that 87,000? Here, it's not here because 87 is from here. Oh, I tak naklah buat benda ni. Never mind. Payment for the interest expense, debit finance cost. My interest expense 40,000, I know. Why is 40,000 just now? 40,000, is there anywhere here? This is the interest paid over 4 years period, right? So the 2% of the 2 million. Interest expense, repayment of 2% debentures, credit bank. Ini repayment of debentures. What is this then? 1 and 4. The term is redemption, repayment. Right, number 1 and number 4, I think it's the same one. Yes. Okay. Okay, so, okay, why do I have this? Okay, I come back to this liquidity ratio because this one will be part of your financial statement analysis later. Yeah, liquidity ratio is to see how much cash the company has in order to pay out for the what? Liability. Yeah. Okay. All right. So let's look at your tutorial question. Right, because the tutorial question is a combination of your liability and equity. Where is the... Okay, let's look this. Can you see the slide, the tutorial question?
Yes, madam.
Can, yeah? All right, so let's look at this. At the beginning of 2016, the statement of financial position of Emerald Berhad is as follows. You have a cash of 325,000 and then you have other asset of 536,000. And then you have shareholders equity, ordinary shares of 5 ringgit each. So this one is the authorized 200,000. Yeah. And so far 80,000 is issued. So 80,000 times by 5, that's how you get the 400,000. Then you have 4% preference shares, capital of 10 ringgit each. So 4%. So now you have the 50,000 preference shares, share premium of 79,000 and retained earnings of 332,000. So these are the following transactions that have not been recorded. So have not been recorded. So that's why you have to do the journal entries. So you do a journal entries and then prepare statement of financial position. So this is the normal question, all right, normal requirement when you do for your shares and your liabilities, all right. So number one is that you have on January 1st, you issued 10% 4-year bonds with 400,000 face value at the price of 440,647. So looking at this, is the bond issued at discount or at premium?
Premium.
At premium, because why? The par value is 400,000, but you managed to issue at 440,647. Right, the bonds paid annually on 31st December and the market interest rate is 7%. Right, so but the bond is a 10%. So what you do, so when you issue on January 1st, right, what would be your journal entries? Remember that the shares is for 4 years, right? So let's look at this. Right, so when you first issue the bond, what you receive is the 44647. All right, so this is the amount that goes into your bank. So you just take whatever given here, all right, 440647 and credit your 7% bond. Is it 7% or 10% bond? Is it 7% or 10%? Let me see. Here we say that 2% debentures. So it should be 2% lah. Right, this is the interest rate, the market effective interest rate. So will it be 10% or 7%? Kat sini pun 7% bond juga. What do you think?
I think it's 10%.
10 or 7?
10.
10%.
10%? I think it should be 10% because it's a 10% 4-year bonds. The market the rate, the current market interest rate is 7%. So for example, in this case, the effective interest rate is 4.5. You don't say that you debit, see, you debit your 2% debentures here, right? So I think that it should be the 2% debentures. So in this case, it should be 10%, yeah? So debit bank and then credit the 10%. Issue 10%. Kenapa 10? Okay, I put it 10 here. All right. Okay, then finance cost for the year. How do you compute your finance cost? Tu tak tahu tu. How to compute your finance cost? Finance cost just now is, what is it? You pay 10% 4-year bonds, 400,000 times by 10% times by 4 years. Okay, so let's look at this. Example here. Receive bond. So this is the one. We have done this. Debit bank, credit your 2% debentures. So far, so clear this one? Number 2, total finance cost. Okay, cash paid over the life of debentures. So what you do is that the interest expense is 10% per annum. So you have the 10% times by, what's the value of the, so you have finance cost here, let's do this. 10% times by, what's the, alamak, tak ingat lah. 400,000, right? 400,000 times by 4 years equals to, what is it? 40,000. Okay? So if you want to take for the year only, how is that? 5%, sorry, interest expense is 2%, 40, this is 160,000. This is 2 million. Ours is only 400,000. So this would be 160,000 also, isn't it? Wow. Ada working terus kat sini ha. Okay, never mind. Alright, so that's how you get common X, common V. But for the year, you're going to analyze only 1 year, right? So your, apa dah 7% point ni? No, 10%. So over the years, oh ni ada 7% ni benda datang. Dr. Intan ada explain tak all this? Okay, let's look again. Redemption value is 5% premium. If I were to follow this, exactly this, right? So let's follow this, right? Number one is that your interest expense per annum is your 400,000. So this is number one, times by 10% times by 4 years. So that would give you, how much is that? Times by 0.1 times by 4, so you have 160,000. Okay. And then number two, let's compute the redemption value. So the redemption value, it says that the bond pay annual on 31st December each year, the current market rate is 7%. So where does that 7% comes in? So the 5% here is the debentures are redeemable at a premium of 5%. In our case, it doesn't mention how much it will be redeemed at. So anyone can help me? Interest payable for the year. And then you are going to recognize F13 minus E11. F13. F13, where is F13? Right, minus E11. So this is E11. E11 is K6. K6 is here. I don't get why is that the finance cost is at 7%. Can anyone help me where you get that 7% from? right?
Is it because of the current market
I
price
can't hear
only?
you. Again,
Is it because of the current market price?
the current market price is the current market interest rate is 7%. So you take that, is it? I don't
I
know.
think
But that's what 7% is, right? If you took that, what is this? This is 7% of 440647. How do you get this? 0. This one, M6. So initially, all right, look at the loan here, yeah. The loan initially it was 440, and then you add your finance cost 7% of this, and then the interest paid of 10%, J minus interest paid. I don't get the logic of this. So this is actually your brought forward plus your finance cost minus your interest, AKL. Does that make sense? So here, carrying amount at the beginning is 1,900, which is in our case is 440 something. The finance cost is the 4%, so you times by 4%. The interest paid is ours is 10% per of total par value, and the carrying amount is 1907640. So if you have these, then these become the opening balance for the following year. Then you compute again, right? So payment made 2101 or 2100. Okay, right, got it. So this should be the finance cost, the 7%, it has to be there lah, right? So what is this? That this is the beginning, right? Finance cost times by 7%. Interest paid is on the face value, 10% on the face value. So that's how you get 40,000. And this is your opening plus your finance cost minus your interest, you get this figure. So whatever your finance cost here goes to your finance cost 3845. So it means that for the year, the finance cost 7% is charged as an expense in your account. Why you debit 9155? 9155 is the difference between your interest payable that you have to pay during the year, right? So you have credited interest payable, but now you have 9155, you debit your bond. So it means that out of the, is it? How does it make? Statement of financial position, your non-current liabilities, interest expense is always at 40,000. Amortization table. So this is the one that we are referring to just now. Interest paid, you have that 40 and amortized premium 54. Where do you get that 54 from? This one, is it? Premium 5149. Oh, ni dia buat year 4, year 3, year 2, year 1 lah pula. Sebelum ni, apa buat year 4, year 3, year 2, year 1 lah. Journal entries for year 1, debit finance cost, credit financial liability. Wah, I pun dah pening ah. Okay, never mind. In the next class, alright, on this part, I will learn first from other lecturers, and then I will discuss the same answer in the next class. Okay, let's move to the second one, right? This one is the one I do not know. March 8, you paid interest cash dividend of 40 per share for ordinary shares. So before you do your journal entries, you have to decide how much is the amount. What do you mean by you paid interim cash dividend? So it means that you're going to credit your cash, debit your dividend. How much is 40 cents per share of ordinary shares? How much is the issued ordinary shares?
400,000.
No, okay, 400,000, but you want to know the number of shares. So you have that 80,000 ordinary shares issued. Yeah, because why? For every each of the shares issued, all right, is 40 cent dividend. So how much is the dividend? 0.4 times by 80,000. So it will be 32,000. So what will be the journal entries? Debit your cash, debit your dividend, credit your cash. I hope that I got it right. Payment of dividend, dia panggil retained earnings, ya. Retained earnings, because your dividend is paid out of your retained earnings, 32,000 credit your bank, 32,000. This one okay? Okay, November 15, issued right issues of 1 for every 8 shares held at face value to existing ordinary shares. So now you have to determine how much is the shares, the bonus, the right issues. In this case, it's not right, it's a bonus issues, isn't it? 1 for every 8 shares. So how many? So 80,000 shares divided by 8 shares times by 1. How many new shares issued? 80,000 shares, and for every 8 shares, so divide by 8, so times by, you get 1. So everyone will get 1 new share. So the total number of shares issued is 10,000 shares. How much? All right. So you're at face value. So the face value is 5 ringgit. So it should be 50,000. Right? So 5 is the price. All right. I will put it here. RM5 is the face value times by 80,000 over 8 times by 1, because for every 8 shares you have with 1 bonus issue. So that's how you get 50,000. So you're going to debit bank, credit OSC. So okay, this one is the right issue. Right issue means that it says not bonus issue, yeah. It says that it's the right issue. Right issue means that you pay at the sepatutnya at lower lah face value, but never mind. Right, so debit your cash, you issuance. This one is issue of right issues. So debit your cash, credit your ordinary share capital of 50,000. Yeah. Are you clear on this? November 15?
Ya, madam.
Okay, yeah. Alright, December 1st, propose a cash dividend lagi, ya. You propose, so means that you tak bayar lagi. You don't pay yet, you only propose. A cash dividend of 15 cents per share to ordinary shareholders pending for approval in the forthcoming AGM. So how many shares? So you want to see how much is the proposal, right? So if there is a proposal, right, you do not put into the, I don't think you have to put that in the journal entries. No accounting entries that the proposed dividend is pending approval. The info, however, needs to be disclosed in the notes to the account, right? Because when you propose, you do not put into a journal entries yet. But you should know that you have to inform if you have the notes to the accounts, you have to put that in the notes that saying that, okay, there is a proposal for a cash dividend 15 cents per share, right? And then you paid preference dividend. So what is your preference dividend? 4% of 10 each. So you have 50,000, yeah? So you pay how much? You paid preference paid preference dividend, and then you paid interest on bonds payable. So let's look at paid preference dividend first. Preference dividends, you have 50,000 times by 4%, right? 50,000 times by 4%, that is a 2,000 paid out from the retained earnings, credit your bank. Yeah, credit your bank. So this is the payment for preference dividend. So how you compute, you have a preference dividend of 50,000 here. So whatever 50,000 times by 4%. Yeah, so 4% is the preference shares punya rate lah. Yeah. Paid interest on bonds payable on 31st of December. This one I'm not sure. So just look at this. Debit interest payable 40,000. So because remember that the interest is 10% per annum on the debenture. So you should do this correctly. All right, debit your interest payable 40,000, credit your bank 40,000. Okay. So that is, so I owe you this one, yeah. I owe you this part. Yeah, so next class I will explain. I hope that I can explain to you better. Right, we will get to this. Okay, the next question is, we have about 15 minutes. So let's go into the next question. You have asset, cash, and other asset. Ordinary share capital, you have authorized 3,100 issued. Right, I would like to highlight that. And then 5% preference shares of 200,000, 4 ringgit each. A share premium and retained earning 443. The following transaction, is there anything else that we have to do here? Prepare statement of financial position. Statement of financial position. Sorry, I forgot to do that. All right, so cash here, how do you have the cash 741647? Remember that you have opening cash is 325. All right, so let's do this. You have cash of, let's see, yeah, cash. How do you get? You get 3 to 5,000, and then add, right, what is the entry? So whatever you have cash here, you add lah. This one plus, what is bank credit? Oh, hold on, yeah, hold on. Okay, 325 plus, ambil je lah ni, 440, and then minus, you have bank credit here, and then you also have a, oh sorry, it's not, plus 50,000, credit bank again 2,000, and then credit bank again 40,000. So what would be your total cash you have is 741,74647. So that's how you get your balance of your bank. Oh, ada working lah. Ni lah kat sini cash, right? So if you do, you open up your cash account, then you have your balance of 741,647 here. All right, and then what you have, your other asset, there's no change. Your ordinary shares capital, initially it was, how much was ordinary share capital? It was 400,000. So if you open up your share capital, ordinary share capital opening 400,000, and then you have a right issue of 50,000. So closing figure is 450,000. Right, preference shares no change, but retained earning, there's a movement in your retained earnings. So number one is that, where's your retained earning? Opening balance is 332,000. Where's your retained? 332,000 here. And then, all right, remember that you have transaction where talk about finance costs. Where's your finance cost? Retained earning before that, right? This one. Is this? 30845 tu masuk kat sini. Okay, because this one is profit and loss item. So they just masukkan lah. Right? And then because it will reduce your profit. And then you have retained earning, debit 2,000, Debit 2,000. What is this ordinary shares? 32,000. What is 32,000? Oh, all right. Right issue just now, I think. Is it? No, no. Payment of dividend. Right, 32,000. Payment of dividend. So you have that 32,000. So your closings 267,155. 267,155. Current liabilities as loan now. Initially bond you is, you don't have any bond here, but then you issue 431,492. Where do you get that from? Initially it was 440,647, but because of the interest, all this, you have this 431,492. So that is what should be shown in your financial position. Yeah, 431,497. So we're going to learn this, all right, in the next class. I will try to explain better on this. Yeah, so I will get some clarification from other lecturers on this. Right, so you have a balance of your asset, equity, and liability of 1277647. Okay, so the next question, all right, similarly, given this, all right, you have this one issued share. So if you are able to understand the first question on this, so the method will be the same. All right, so you see that issued 8% 5-year bond, 5-year, 300,000 face value for 282. So it's issued at discount. Bond pay interest semi-annually on 30th June, and the current market interest rate is 9.5%. So maybe because the 9.5% is the interest that you pay. Okay. I can actually remember, I already remember how to do this table, right? You have the opening balance of your bond, and then you take the interest rate here, and then the 10%, or in this case, your 8%. Yeah, but then I want to understand better, right? Why is it like that? If I were to write it down here like this, I can do that, especially using an Excel. But I want to understand better. All right, and then here you have the issuance of share capital. All right, and then remember that this issuance cost will be deducted. So here you have 50,000 times by 8 minus 6,000. So you're going to debit your cash, credit your ordinary share capital. Right, so remember that you have the where you get 282. Ni apa ni? Oh, bond. Tak. Right, this one. Right, your RM8 times by 50,000 minus 6,000 ringgit of the issuance cost. So debit your bank, credit your OSC. Declare, distribute 1 for 20 bonus issue to all ordinary shareholders. Retained earnings are used for this purpose. Market value per share on the date is 4 ringgit. Declare and distribute, right? 1 for 20 bonus issue. So for every 20, you'll get 1. So how you compute that? So you compute that, remember that the share price on that day is 4 ringgit. 4 ringgit, how many shares that you have? Share capital 300,000 plus 50,000 here. Remember, you have additional issuance, yeah? All right, so 300,000 plus 50,000 divide by 20 times by 1, right? So that is the issue. That is, how much is that? 70,000, right? So let's do it again. For you have 300,000 initial shares plus 50,000 new shares. So you have 350 divided by 20. All right, 17,500 times by 4, because for each shares is 4 ringgit. So that's how you get 70,000. Right, so debit your retained earnings, credit your ordinary share capital. All right, and then declare ni done, paid interest on bonds payable June 30th. So is this for half year and semi-annually? All right, so it means that 300,000 times by 8% times by half or 0.5, is it? Right, oh yang ni dia tak tunjuk pula. Mana I tahu kan? How much is it? Let's do it. 300,000 times by 8% times by 6/12 because it's a interim. Is it? So let's do 300,000 times 0.08 times 0.5, 12,000. So that's how you get 12,000. Yeah. Why? Because this one is the interim, the first half of the interest. So the 8% is the interest on the bond. Dividend to ordinary share. Alright, declare and distributed a 140 done. A cash dividend of 20 per share to ordinary share approved payable on 31st next year. So next year it becomes, in this case, it's approved, yeah. So just now the previous one, it was not yet approved, but this one is approved, so it becomes a liability. You don't pay yet as of 31st of December, on December 5th, but it's going to be a dividend payable. So you're going to debit your retained earnings, right? How much is the cash dividend? 0.2 per share. So how many shares do you have? 350,000, right? Oh, 350,000. But dia ada bonus shares tadi kan? Yeah? Remember your bonus shares 17,500 units? The bonus shares 350,000 divided by 20. So you have 300,000 plus 50,000, the new shares, and 17,500 is the bonus shares. Yeah? So total times by 20 cents. So that would be your retained earnings, debit your retained earnings, credit your dividend payable. So you're going to pay that later. Pay your preference dividend and pay interest on bond payable. So your preference shares is 5%. So 5% times by 200,000. 5%, 200,000 times by 0.05 is 10,000. Your preference shares is 10,000. Debit your retained earnings, credit your bank. Interest on bond, all right, this one is for the second half. Right, the second half will be interest payable 12,000 and 12,000. All right, so when you need to do the cash, the statement of financial position, so you have to do some workings on the cash account, ordinary shares, and your retained profits, yeah, in order to get the updated balance of your accounts. Okay, I will share with you this solution, right, so that you can refer to it. And again, on next class, I will continue with your cash flow. And then, of course, my, this one is my, I hutang you, right, on this. Yeah? All right, it's already 3:16. Do you have any other question?
No, madam.
Yes. No question? All right, let me put in this later in the all right, if you don't have anything, then I'll see you again, inshallah. Please review, yeah, this topic. I know that the liability, the bond part is very challenging, but I'm sure you can do it, right? It's okay, you can do it. Yeah, so just refer a bit, and I'll come back, inshallah, in the next class on the new topic, cash flow, and on the bonds, yeah? Tutorial topic 10, and this one is the solution. Okay, so it's already there. So please do again the question, right? Because definitely this will be in your final exam. Any other question? Tak ada, ya? So if not, then I think that's all for today. Please don't forget to fill up your attendance form. And inshallah, I'll see you again with that. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam.
Thank you, madam.
Thank you, madam.
Thank you, madam.
Thank you, madam.
All right.
Excuse me, madam.
Yes.
Is it true that I heard for accounting subject they will combine classes for next semester?
Sorry.